Hello, I'm Bob Peelman, the Director of Wealth Advisors here at OJM Group, and today we're going to be discussing, do I really need an investment advisor? Reasons investors underperform without professional management. Before we jump in, it's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. Also, please review closely the disclaimers at the end of this presentation as well. One other note before we get started, if you find the information that we discussed today helpful, we would encourage you to check out one of several books that we have written. We'll discuss more at the end of the presentation. Today's webinar covers just one topic in our newest book, Wealth Management Made Simple. We're very excited about this new book. The authors, to which I'm one of them, provide answers to common questions that you have heard, that we have heard from our clients, including market history tips, investment terminology, tips for choosing your advisor, and more. I'll let you know at the end of this presentation how you can get a free copy. Specifically, some of the topics we're going to talk about today by the numbers, specifically what the issues are in regarding managing your own assets, being your own financial advisor, and what some of that data looks like over the last 10, 20, 30 years. What are some of the common investor mistakes? What do we see out there? What has been studied to show why investors make some of these mistakes when managing their own money? And then again, we'll talk next steps at the end of the book, a little bit about what we do here for clients at OJM and how you can reach out to us. So specifically by the numbers, if we look at historical data showing retail investors, they seem to make the same greed and fear mistakes time and time again, buying investments when prices are high and selling them once they have fallen. This is a trap that many investors get into time and time again. And we'll talk a little bit more in some slides ahead about some of the behavioral finance reasons for that and why the emotional nature of managing your own money is one of the biggest pitfalls that we see time and time again with clients. According to the 2016 release of Dalbar's Quantitative Analysis of Investor Behavior, which is a fantastic piece going into some of the psychological reasons why investors underperform the markets or have historically with some proven data. But their latest release shows that the average investor in a blend of equity and fixed income funds has a return of 1.89% annualized, and this is the 10-year period ending with December 31st, 2015. Conversely, as we all know, we've been in a very good market environment over the last 8-9 years, going back to the end of 08, spring 09, when we really bottomed out in the market. So during that same period, the S&P 500 has returned 7.3%. So you see a clear underperformance against the index for the broad individual investor. The same average investor hasn't fared better over longer time frames. The 20-year annualized return comes in at about 2.11%, while the 30-year annualized rate is 1.65%. Versus what we all know, the S&P 500 during those time periods when we hear about long-term returns, 8.19 and 10.35. So I guess the biggest question we get is why? So what are some of the big reasons that investors typically underperform? Because we will often tell clients that discipline obviously is a major part. If you were to simply buy index funds, not pay attention to the markets, not turn on the television on any particular day, not hear all of the white noise that's out there, and stay completely disciplined to your plan, that as you saw the index returns, you're going to be in good shape. Now, again, everyone has different time horizons and different periods where they may need to change or alter their financial plan, and that's something that we are constantly working with our clients on. But the reason that folks don't get those index-like returns is a lot of emotion comes into play. And a lot of irrational decisions are made. And I'm going to walk through and show you some slides here today on what are some of those patterns that we've seen over the years? Overconfidence, hindsight bias, short-term focus, regret, mental accounting, and hot hand fallacy, as we call it. So let's jump into the definition of overconfidence as it relates to investments and investor behavior. Rating oneself as above average when it comes to selecting investments. This is time and time again. Investors, I spend more time doing this. I understand the markets better than the average investor. I enjoy this. This is, I've had a great track record. So when you consistently talk about your performance as an individual investor, you begin to get overconfident. And a lot of times that can miscalculate the probability of potential good outcomes into the future, focusing more on the potential upside investments. So really focusing in on what investments did well, what were all of my wins, and not emphasizing the potential downside of investments. So here's a great chart of false perception. So looking at the historical performance of emerging market stocks from 2015 to 2016. So for the first 3 years, stocks in these regions produced impressive returns, generating double-digit gains. So based on this stellar track record, what would a typical investor have expected in 2008? They'd probably expect more of the same. Well, 2008 wasn't quite dismal for investors in emerging market stocks, as it was dismal, as they lost a little more than half of their investments, 53.2% to be exact. In 2009, however, emerging markets rebounded, producing a return of 79%. Could this be the start of another string of impressive returns? Well, in 2009 and 10, yes, but not in 2011. And recently, emerging markets had a 3-year run of underperformance. So we often heard from clients, should I have emerging market exposure? All the periodicals, the magazines I read tell me I shouldn't have any emerging markets. Why do we have emerging markets? And now, again, you see, emerging markets are having a fantastic year in 2016, and so far in 2017, they're up about 23.5%. So continuing to do very, very well. So a lot of decisions can get made based on previous track records and a sort of a overconfidence on how things have performed recently versus what we think they're going to do in the future. And again, it goes back to the proper asset allocation, the proper percentage that you should own in any particular asset class that makes sense for your financial plan. Hindsight bias. So believing that unpredictable past events in retrospect were obvious and predictable. This is another one that we hear quite a bit. The implications of this are feelings of anger and regret, failure to avoid what appears to have been foreseeable, and then once again, some overconfidence. So again, as we look at it, many people claim to have seen the writing on the wall when it came to the various bubbles, whether it be the technology bubble of the early 2000s or the recent real estate bubble. However, when a so-called obvious bubble was beginning to take shape, it most likely would have not have heightened and eventually burst if most people had known of the eventual outcome. So if you're looking at the technology bubble there or the real estate bubble, that that image on the left is illustrating how well an investment in companies specializing in technology would have done from 1992 up to 2000. And the image on the right is looking at the housing market from 1991 and what happened through early 2007 in home values. So hindsight bias is quite evident among these individuals as they look at this and think many of these events were foreseeable, and that's just not the case. And real estate investments are certainly subject to risks and local economic conditions, interest rate fluctuations, credit risks, liquidity risk, corporate structure. I mean, there's a variety of reasons that make it very complex to look at a potential bubble in a particular asset class. But a lot of folks will look back at these particular and have the benefit of hindsight and look at it and say as though these are things that they should have seen. Can have a very negative impact on how you're building your portfolio. Short-term focus, inappropriately focusing on short-term risk versus long-term risks. This is another big one. The implications, many investors talk long-term but act short-term. Overly sensitive to interim volatility regardless of time horizon, and may tend to behave as though their time horizon is far shorter than it truly is. So, avoiding potential near-term losses, a choice of asset allocation after examining different return distributions. So this is a study, risk aversion or myopia, that was done by one of the professors at UCLA and the University of Chicago. They had a group of participants that were contributing to retirement plans, defined contribution plans. And the participants were divided into two groups. And each group was told that they could choose between only two funds, A and B. They were then given some information about the historical returns of these funds and were asked to decide, based on this information, how much of their retirement money they would invest in each fund. The returns for the funds were derived from actual stock and bond returns. So the manipulation in the experiment was the manner in which the fund returns were displayed. One group was shown a distribution of 1-year returns for both stocks and bonds. The other group was shown a distribution of 30-year returns. The academics at UCLA predicted that subjects viewing the 1-year chart would invest less in stocks than the subjects viewing the 30-year chart. They based their forecast on the fact that the 1-year chart accentuated the perceived risk of investing in stocks. They stated that over a 1-year period, the likelihood of stocks underperforming bonds is about 1/3, while over a 30-year period, it's only about 5%. And here you can see the results. So the results found that the group looking at their distribution of 1-year returns allocated their portfolios much more conservatively, 60% to bonds, 40% to stocks. In contrast, the group that saw 30-year distribution return distribution allocated their portfolios much more aggressively, 10% into bonds and 90% stocks. So exposure to a frequency of returns tends to affect an investor's tolerance for risk. So when we think about every day in the news cycle, breaking news, geopolitical events, laws, whether they're going to be put into place, whether tax reform or healthcare reform or whatever it may be, that you can see how in 1-year return cycles, looking at things calendar year, folks become a lot more conservative. And we hear this time and time again when we're having annual reviews with clients. Markets are at all-time highs. Should I be in this asset class? And so we spend a lot of time talking to our clients about their plan and what their allocation should be to help them achieve their plan, and really shift the focus on not having this type of short-term focus and bias. Regret, having illogical feelings of guilt because of a poor outcome, and as it relates to their investments. So investors, the implication would be investors' future investment decisions might be affected. Can cause investors to become more risk averse or risk tolerant, and these individuals may blame advisors for perceived mistakes. So here's a nice chart, the regret of action versus inaction, analyzing various types of regret. We look at this situation. Investor A purchased shares in company ABC on January 1st, 2007, and the investor consequently sold the shares at the end of the January 2009 because of poor performance of the company. Well, investor B considered purchasing shares in company ABC on the same day investor A sold, but after much consideration, decided to take a pass. Well, as you look at the chart, company ABC performed very well from February 2009 through December 2012. We would look at this and say, which investor is unhappier as a result of this decision? Logically, the economic outcome is the same, and therefore both investors should have the same amount of regret. However, studies have shown that the regret of having done something is greater than the regret of not having done something, not done anything. Therefore, investor A is experiencing more regret. So, there's a lot of studies on stuff like this, and we make sure all of our advisors are educated and understand the behavioral finance aspect as it relates to clients, and it really helps us walk clients through decision-making processes as it relates to volatility in the market and short-term decisions. But I think this is a fascinating slide on understanding some of that regret. Mental accounting, basically ignoring the aggregate of your portfolio. So investors tend to disaggregate a diversified portfolio, and the risk and return components are viewed strictly in a vacuum, and it leads to a heightened concern about the risk of a component of a portfolio. So if we look at the sum of the parts, the risk and return characteristics of these asset classes from 1970 through 2016, you can see the risk metric, risk percentage of each of the asset classes with the given return. So different types of investments will perform differently from one another, which makes it possible to lower the risk of volatile assets by combining them with other assets in your portfolio. But if these are all viewed individually, and one asset class focusing strictly, say, on international or small caps, for example, may lead investors to feeling very uncomfortable about their volatility. So we really focus in on making sure that a portfolio is weighted around the proper asset classes that make sense, adding in alternative investments as well, and looking at a portfolio holistically from IRA accounts, qualified plans at your work, taxable accounts, trusts, LLCs, whatever it may be, and looking at making sure that we're looking at the total picture of investments and the risk you're taking, and not one specific asset class. A lot of folks will focus in on one, and it may change their risk tolerance. And finally, hot hand fallacy. This is a very, very big one. So perceiving trends where there just is not a trend, or consequently taking action on this faulty observation. So investors tend to desire to invest in last year's winner. Skill is inferred from many times a random pattern of chance, and it can lead to a lot of erroneous assumptions and predictions. The famous quilt chart of looking at asset allocation in these variety of asset classes, you can see the colors there at the bottom. The gray is a diversified mix of all of these asset classes, green treasury bills, which is very conservative and safe, to long-term bonds, international stocks, large and small U.S. stocks. When we look at this, it's very difficult to predict which asset class is going to be the best or the worst in any given year. And performance of one asset class over another can have a drastic change from one year to the next. And if you look at this, in times when one asset class dominates all others, as was the case here with international stocks from 2004 to 2007, it's easy to lose sight of the fact that historical data shows it's impossible to predict what is going to be the winning asset class for any given year, year over year after year. So after 4 fantastic years, international stocks fell to the bottom in 2008, rebounded to the top position again in 2009, and then fell once more to the bottom in 2011. So, a diversified portfolio, as you see here, it may prevent an investor from capturing top performing returns in any given year, but it also protects an investor from experiencing extreme losses. So for example, in 2016, a diversified portfolio would have returned about 8.2%, which was approximately 17.4% lower than the top asset class that year. However, the diversified portfolio would have also performed better than the worst performing asset class, treasury bills, by about 8%. So a well-diversified portfolio will allow investors to mitigate some of the risks associated with investing. So hopefully that opens some eyes, some good data on what we're talking to our clients about, every single day, and how we work with our clients. Here's a little bit about how we manage portfolios for our clients. We have an institutional investment approach tailored to individuals. So we do think of money long term, Institutionally, as large endowments manage assets, we take that similar approach using alternative investments. We have a dedicated investment team, investment experts who focus solely on asset management here at the firm day in and day out. They're not trying to be a generalist and know a little bit about everything, but know quite a bit about this specific topic. Strategic asset allocation is very important to us, but we call it a fat pitch, but we do look for opportunistic decisions, whether it be security selection or asset classes in a 5-year period or sooner. So we may weight one asset class over the other, but we do try to stay pretty disciplined to our strategic asset allocation. We believe strongly in non-correlated investments, and a lot of times that comes in the way of alternative investments. Alternative investments could be real estate, could be precious metals, could be managed futures, long-short equity funds, MLP, oil and drilling reserves. So we do all of that as we're managing our portfolio, but we have the support of our whole team here at OJM. So we're working all towards the same goal for our clients. Any tax, insurance, estate planning, asset protection issues can all be addressed in a very coordinated manner by other experts within OJM. So today I covered one specific topic in the area of investment management, investment wealth management, but we have experts here at OJM in all the other areas, whether it be insurance, asset protection, tax, benefit planning, and we have the multidisciplinary team that includes attorneys, CPAs, CFPs, MBAs, investment and insurance professionals. Our team has been helping clients, physicians, business owners, professionals. In fact, we've worked with over 1,000 clients in over 48 states, and we can work with individuals or medical practices on a corporate engagement or on a personal planning engagement. We work in 3 different divisions, as I mentioned: consulting, insurance benefits, and our investment management team. Next steps to get a free copy of Wealth Management Made Simple, For Doctors Only, or one of our other books referenced earlier in this presentation. You can receive your free book or ebook for Kindle or iPad by visiting www.ojmbookstore.com and use the promotional code OJMWEB at checkout. I would love to have a free consultation with you. My contact information is here as well, and we will walk you through how we work with clients, if there's a fit, learn more about your situation, and see what tools that we can use to help you with your portfolio and your overall wealth management plan. Thanks for listening.